Well, nothing is foolproof in this world, right? All we're trying to do is get probabilities in our favor to try and roughly assess. But here's what's simple is if you look at a chart of the ISM over the last 50 years, it goes up and down in cycles. The economic cycle, we all hear that term. What it means is kind of, that if it's rolling over, it's likely to go all the way to recession. It doesn't always happen, but your probabilities are high. And once you're in recession, it tends to start picking up again. And that gives you the green light to maybe buy some of these things.
The stock market has thus far had a brutal year in October and may not necessarily bring the relief traders are hoping for, economist Raoul said over the weekend in a series of tweets. Speaking to his 828,000 followers on Twitter in a long thread, the macro guru provides his take on what has recently been going on in the crypto space and gives some key takeaway advice for those that want to hear. What happened? Powell said. October is the month stock market crashes. It is also the month that kills bear markets. He delved into the previous October crashes and the events following those. The October 18, 1987 crash is the one that is stark in the minds of market participants, Powell said, adding that Paul Tudor Jones nailed it by overlaying the 1929 crash. A 50% rally followed the 1929 crash and a depression set in subsequently until 1932, Powell noted. Powell also mentioned the 2008 October crash, which ended in November, but the generational low came in March 2009. Something similar to what is seen currently happen in 1974, and it marked a generational low, he added. The 1997 October crash was precipitated by the Asian crisis that resulted in a generational low, Powell noted, adding that more importantly, the Fed was forced to pivot. October scares. October is always a scary month for markets, Powell said, adding it would be particularly true if the economy is in the midst of a recession. In a new interview on the Tech on Top YouTube channel, Raoul gives an update on the current state of the market. He shared much insightful analysis which you can't afford to miss. Therefore, like the video, subscribe if you are yet to do so, and enjoy the video.
So in a very simple terms, you're looking, the 50 line in the ISM is roughly where it goes to contraction or expansion. If it's coming down and going through 50, you start to worry about recession. So currently, while we're doing this, I think the ISM is somewhere around 52 and on its way down. So we're starting to think, oh, there's probably a recession coming. And when it comes up through 50, you're kind of being given the green light.
So you mentioned under 50 there. I think you said in a previous podcast, 47 was roughly the benchmark. Is that correct?
47 is the benchmark for a recession.
Okay.
But generally speaking, things get a bit wobbly once you get through 50. And 47 it tells you, okay, the economy is now in recession.
So the $1 million question is now, where are we in terms of market cycle? First off, let's start with where we are in the market cycle, and then maybe we can go into kind of recession-proof investing, if there is such a thing.
Yeah, once you've figured out the ISM and how it works, you can then find things that lead it. So that gives you an ability to forecast, okay, what it looks like. Currently, I'm using a mix of the rise in interest rates, the rise in commodities, and the rise in the dollar. And it's like financial conditions. And that's suggesting that the economic cycle goes almost immediately to recession and pretty sharp. And I think a lot of people are sensing that is happening. You're hearing it from companies. You're hearing it from a lot of people to say, yeah, looks like we're going to recession. So the forward-looking stuff suggests we're about to go into a severe recession. Now you need to figure out, well, what are asset prices pricing in already? Because you can't trade on today's news. You need to trade on tomorrow's news. And really speaking, you need to trade 6 months out news. And so where are we? So if I look at the year-on-year rate of change that I talked about, if I look at the S&P 500, it's already pricing in about 42 in the ISM. So a full recession below that 47 level. Could it go a bit further lower? Yes, because my forward-looking indicators suggest the ISM could get down to 40 or so, maybe a bit lower. But we're kind of in the right zone to say, actually, a lot's been priced in. Could there be one leg lower? Maybe. But that means that as an investor, your spidey sense should be up saying, hey, is the opportunity coming here to buy when everybody else is fearful? So again, my forward-looking indicators suggest that the economy picks up maybe in the first quarter of next year. So in which case the markets will start to forward look some of this. So it's It's actually a little bit of a tricky point in time today, but we're getting very close to the time where the markets will start saying, okay, I can see what's going to happen here. The economy is going to go into recession. The Federal Reserve will stop raising interest rates, as will the other central banks. And chances are things start reversing again.
How would you say to navigate if we do hit that 47, as you mentioned on the ISM, if we do start to see indicators of a recession, how would you move from here?
So generally, he who has cash in a recession is king, because you want to be ready when nobody else is, when everybody's being forced to throw all their trades out and stop themselves out from losing money. You want to be able to buy. So you kind of want to have cash ready, and then you want to see what the economy does, and then start to see, hey, are bond yields coming down? Are the Federal Reserve going to stop raising rates? Those are kind of signals that the future economy in a year's time is not likely to be as bad as what we're seeing coming in the next 3 to 6 months. And it's that transition that becomes very interesting for investors. So, basically, if you're young, you should be risk seeking. If you're old, you should be risk avoiding. It's as simple as that. So if you are young, you should be looking at, okay, how do I take an advantage of the sell-off in crypto and the sell-off in stock markets and technology stocks? Because those are the things that will drive returns over the next 10 or 20 years. But if you're older and you're retiring, you want to stay in cash for longer. You don't want to take as much risk because you don't have an income. So your grandparents don't have an income anymore. So it's just their pension. So they need to be careful, very careful with their pension. Their nest egg has to be protected at all costs.
And now when we look at learnings along the way, things that you've picked up along the journey, is there any things that you've learned from, say, 2008 that you can put into practice here? Or is this a different ballpark?
Everything is always different, but it's always similar. The question about 2008 was different. 2008, we had a financial crisis. So we had another thing. It wasn't just the economy slowing down, but we had something much worse. And 2001 was much worse. We had the biggest stock market bubble in history that unwound. This time around, I'm struggling to see what that big thing is. Yes, we've had inflation, which is different to the prior cycles. But inflation is also driven by the business cycle, and it should come down over time. So I don't see the really terrifying outcome. Of course, some companies might go bust. People will lose their jobs. Maybe some weaker economies will suffer badly. But generally speaking, I'm not picking up, oh my God, we've got a debt crisis coming or something really bad. So I think it is different. And so a lot of people are expecting the next leg down. Is this going to cause the crash? I mean, the market's already down. I mean, the Nasdaq's down 27%. It was down 35% or so. It's pretty much crashed once already, but people are like, can it go down 50%? Because they look back at 2008 and 2001 and said, see, it can do that. When you go back to other recessions like 1990, it was a 20% correction. In fact, even when the Volcker years, the famous time when Paul Volcker was raising interest rates and slaying inflation, the market fell 27%. So it wasn't the big one. But 1974, it fell 50%. So we don't know whether it's a 50% sell-off, which is usually driven by something much worse, or something around 30%, which is roughly what's priced in right now. I'm erring to the 30%, so i.e. the risk reward is looking more attractive than if we were in 2008, where we had something much worse going on.
Bear market in U.S. stocks still in its infancy versus history. The S&P 500 is down 25% from peak in little more than 9 months. The average top-to-bottom drop is 38% over 15 to 16 months. Investors seemingly can't stop trying to pick a stock market bottom, no matter how bad the news, and it continues to backfire. Getting inflation down will mean discomfort for the economy and for investors, who are concerned higher borrowing costs will cut into corporate profits and lead to lower stock prices. But the Fed is unlikely to change course based on 1 or 2 reports. Instead, they committed to ongoing interest rate increases to prevent inflation from getting baked into the economy permanently. Already, consumer spending is flat even without adjusting for inflation, and homebuyer demand is at a 22-year low as average rates for a 30-year mortgage now exceeds 7%, the highest in 2 decades. This seemingly bad news shows the rate increases might be working. If the hot labor market begins to cool, that would be another welcome sign that inflation is getting under control. There's no doubt the Fed is closely monitoring all of these metrics. What should investors do while all of this is happening? As year-end gets closer, experts recommend staying the course and dollar cost averaging toward your long-term investment goals regardless of what the market is doing. This is a great time for investors to get in slowly, but definitely take advantage of these times, says Vanessa Martinez, CEO and founder of Empowered Network, a consulting firm. It's a good idea to take a look at your budget and, if you can, slightly increase the portion you're putting away for investments to dollar cost average into the market, she explains. Here at Savvy Finance, we continue to dollar cost average in our purchase of Bitcoin and other cryptocurrencies, and we advise all our viewers to do the same. What do you think of Raoul Pal interview? Let us know your thoughts in the comment section. Thanks for watching.